We want to bring in Tom Hayes, Great Hill Capital Chairman and Managing Member. Tom, it's great to see you and great to have you here in studio. So a strong start to the year, which historically means that maybe we'll have a strong rest of the year. What do you think's in store?
Well, I think we came in with really low expectations. If you look back to the beginning of 2022, consensus was that we'd close the year at 5,241. We closed at 3,800. This year, consensus is that we're going to close 2023 at 4,031. So estimates are really low. Expectations are really low. And even looking at earnings, which starts on Friday, estimates are that earnings are going to drop negative 4.1%. However, if you look at the Atlanta GDP now, which tracks Q4 GDP, it's saying that GDP was plus 4.1%. As they say in Texas, that dog don't hunt. One of them is going to be wrong, and we think that estimates are really low, and it's going to set up the positive beats moving forward and more positive guidance than expected because people are very, very pessimistic.
Story of my life, man. Set the bar low. It's easy to jump over it. Been doing that for 30 years.
Low expectations is the key to happiness.
Where does the bottom come in with the S&P? Some are talking 3,000, 3,200.
You know, it's interesting you mentioned that. That's consensus, and I think when everyone's looking for the same thing is usually when you don't get it. And everyone's looking for a weak first half and a strong second half. I think the surprise of this year could actually be a strong first half and a flat second half, and that's going to be driven by earnings. And we have to keep in mind the Fed. You know, everyone's saying, oh, I'm worried. The Fed keeps talking hawkish. You got to believe the Fed. You got to believe the Fed. Well, the Fed told us last year that the Fed's funds rate was not going to get above 1%, and we ended the year at 4.25. This year, they're saying we're going above 5.1%. I would take the under. I would listen to the bond market, and the bond market's telling you that's not going to happen. And we have to keep in mind they're not going to send you an invitation in the mail, Dave, and say, hey, in 3 weeks we're going to pause, or in 12 weeks we're going to pause. You should buy equities now.
Jamie Dimon threw out a 6 bomb though yesterday.
Jamie
rates a 6.
Yeah, he makes money on the spread, but so I think you want to be buying these high quality companies when they're on sale. I know the last time I was with you 4 or 5 weeks ago, we were talking about Amazon. You couldn't give it away. Now you look at today, everyone wants Amazon. And businesses like this, Amazon has grown its AWS and its ad business by 300% since 2018. It's trading at the same price. It's doubled its e-commerce business, and no one could give it away. So we're looking for things like that on a selective basis. But I do think the surprise, based on positioning, based on sentiment, is going to be to the upside in the first half.
Yeah, Amazon certainly had a very, very strong start to the year. Tom, you also like emerging markets. You think the underperformer of the last couple of years, things are going to reverse course this year. Why do you like them, and what's going to lead?
Yeah, the last shall be first, right? And that's consistently the case. As a matter of fact, if you look at the asset class mosaic every year, what underperforms, what outperforms, it's very rare to see an asset class 2 years in a row down at the bottom, not get to the top in the next year. And that's what we've seen the last 2 years with emerging markets. What's the driver? The driver is you need to see relief in the US dollar, and we finally got it 2 months ago. The dollar is down about 10%. And if you look at history over the last 20 years, the last time you had these type of drops in the dollar, 2002 to 2007, emerging markets rallied 480%. 2009 to 2011, the dollar came down, emerging markets up 198%. 2016 to 18, 100%. 2020, 2021, 95%. The biggest weight is China. We love China. The crackdown's over. The lockdown is over, and they've just set GDP targets for this year at 5%.
You're buying that reopening is for real, and we're not going back to COVID zero again.
There's no going back. They've already basically got herd immunity, or the equivalent of. They're getting the medicines, the Paxlovids, and everything that they need to take care of their people. And they've been stimulating, believe it or not, since March. It just didn't take because everyone was locked down and they couldn't get out and spend.
And so what names do you like there?
Oh, well, look, we've been buying Alibaba for months. We've been averaging down. Our last purchase was at $61. Our basis is higher. We think it's incredibly cheap. You can still buy it. Even it's rallied the last 2 months. It's rallied 98% off the lows. You can still get it at 2014, near the IPO prices. And the difference is revenues are up 800%, earnings are up 500%. Oh, and by the way, they've got 38% share of the cloud business in China. That's going to triple in the next 2 years, the cloud business and their share at 38% is going to add 66% of operating income to that business. So we really like Alibaba. That's a bellwether for China and emerging markets.
You're not alone. Goldman Sachs, Morgan Stanley, both coming out this week saying that Alibaba was one of their top picks here for 2023. Tom, we're going to get earnings really underway at the end of this week when we start hearing from some of those big bank names. You mentioned at the top of the segment here that you think there's a little bit too much pessimism when it comes to fourth quarter earnings. What do you think we're going to hear from some of those big banks?
Yeah, well, it can't get much worse. I mean, they had basically no banking business last year. I think in Q4, though, you started to see some financings come in Q4. So the investment banking business might be slightly better than expected. Not materially better, but, you're coming off low expectations, the key to happiness. And that's what we have going into Friday. So I think the banks will be okay. I think you're seeing, you saw today the refinancings pick up. I heard you at the top of the show. And that's going to happen more and more. The 10-year yield's down to 3.5, down from 4.23. The market's saying, we appreciate the hawkish talk, but we know sometime in the first half of the year, the pause is going to be on. They will keep rates elevated as long as they can, so long as the economy doesn't slow. But you saw a very similar situation from 1995 to 1999. People say tech can't do well now because the Fed funds rate's going to get over 5%. What was the Fed funds rate from 95 to 99? It was 6.5, and they kept it elevated for 4 years. So I'd be open-minded that some of these companies that have been cut in half are opportunities moving forward.
Oh, how we forget. Great reminder there. Great Hill Capital, Tom Hayes, good to see you, my man. Thank you.